Hello and welcome to this week's edition of Echo45 Advisors Market and Economic Update. In this video, we'll discuss two significant developments at the Federal Reserve that have taken place around the same time: the passing of former Fed Chair Alan Greenspan and the first meeting chaired by the Fed's newest member, Kevin Warsh. These two events offer an opportunity to reflect on how the Fed has evolved over the decades, what might be changing under new leadership, and what all of this means for long-term investors. First, it's worth stepping back and putting Fed leadership in historical context. The U.S. economy has grown across many different Fed chairs nominated by presidents of both parties. Each of these leaders faced unique challenges and shaped the playbook for those who followed. For much of Greenspan's long and complex tenure, the Fed didn't even publicly announce its rate decisions. Markets had to infer what was happening by watching short-term interest rates. It wasn't until 1994 that Greenspan introduced a practice of issuing statements when rates changed, and even then, the language was brief and often deliberately difficult to understand. The more modern tools that we associate with the Fed, including regular press conferences, detailed forecasts, and forward guidance, were developed under Ben Bernanke, Janet Yellen, and Jerome Powell, often in response to major economic crises. The key takeaway here is that the Fed has evolved over time and does not drive the economy on its own. Underlying forces like technological innovation and demographic trends play a much larger role. The economy has continued to expand over long periods despite very different approaches to monetary policy. Next, let's look at what's already changing under Kevin Warsh, who chaired his first Fed meeting in June. Warsh has argued that the Fed's communication has become too complex and too forward-looking. At his first meeting, he significantly shortened the Fed's official statement, removed language that hinted at future rate moves, and declined to submit his own economic forecasts to the Fed's projection summary. He also announced 5 working groups to study different aspects of the Fed's operations, covering communications, data, the inflation framework, the balance sheet, and the impact of AI and technology. The last area is particularly interesting for long-term investors. As this chart shows, productivity growth has been uneven across the decades, with a noticeable boost during the technology-driven expansion of the 1990s. If AI delivers productivity growth, it could support both economic growth and lower inflation over time. This is far from guaranteed, and measuring that impact in real time is difficult. But even small sustained improvements in productivity can compound into significant economic gains. In the near term, the Fed is still navigating a challenging environment. Ongoing uncertainty around energy prices and inflation means the committee is divided, with roughly half expecting rates to hold at current levels through the year end and the other half expecting them to move higher. Finally, interest rates are not the only tool the Fed has at its disposal. Its balance sheet is equally important. As this chart shows, the Fed's balance sheet stood at under $1 trillion before the 2008 financial crisis. It then expanded dramatically as the Fed purchased bonds to support the financial system. Today, the balance sheet stands at $6.7 trillion, down from a peak of nearly $9 trillion in 2022. Warsh supported those emergency expansions at the time, but has argued that the Fed was too slow to reverse course once conditions stabilized. The broader point for investors is that the Fed's approach to policy is not fixed. It has always evolved in response to economic conditions, new research, and the judgment of individual leaders. Less forward guidance may mean fewer policy signals and could also introduce more uncertainty about how the Fed will respond to new developments. What matters most for long-term investors is not any single policy decision, but the underlying trends that drive the economy. Many of those trends remain positive today, and maintaining a well-constructed portfolio and a clear financial plan is still the most reliable path to achieving long-term goals. We hope you found these insights helpful. If you would like to discuss the Fed, monetary policy, or how these developments might affect your portfolio, please don't hesitate to reach out. We look forward to speaking with you.